Well, hi there, and welcome back to Reflections in Real Talk. I'm your host, Judy, and today I'm going to uncover one of the sneakiest drains on your retirement savings, hidden expense ratios. Not only will I explain what expense ratios are, but I'll show you how to find them, even when they're buried in the statements or listed under different names. Let's get started. Expense ratios are the annual fees funds charge investors for management, administration, and other operational costs. So, in order to calculate the expense ratio, we need to know two things: the total annual fund expenses and the total assets under management. In this example, the expense ratio is expressed as a percentage and represents the cost to investors for holding the exchange traded fund on an annual basis. So, this particular fund in our example has $5 million in annual expenses and $1 billion in assets under management. So we take the assets divided by the assets under management times 100 to arrive at an expense ratio of 0.5%. This means investors will pay 0.5% in fees. Sometimes you'll hear expense ratios expressed as a basis point. That's because basis points provide a clearer and more precise way to express a small percentage difference. So, for example, 1 basis point equals 0.01%, which is 0.001 in decimal form, where 100 basis points equals 1%. So you can see it's a lot easier to express as a basis point. For example, an ETF with an expense ratio of 0.25% is said to have a 25 basis point expense ratio. And if another ETF has an expense ratio of 0.05, it has a 5 basis point expense ratio. These are costs the investor pays through a reduction in the investment's rate of return. That's what's so sneaky about them. You won't see them prominently listed at the top of a statement as in, this is how much you paid. You'll just earn less money, making it almost invisible to you. This is why it's important to educate yourself on expense ratios and know what you're paying. These fees might seem very small, expressed as a percentage like 0.05, which is 50 cents per $1,000, or 0.5, $5 per 1,000, but they can quietly erode your savings over time. For example, paying 1% instead of 0.04% could cost you tens and thousands of dollars over years of investing. Expense ratios alone can make a huge difference in what you can save over a lifetime. That's the power of compounding. We can apply the same principle to retirement savings over a 40-year retirement horizon, and you will see that expense ratios alone can make a huge difference in what you can save over a lifetime. So let's look at an expense ratio calculator together. I'll drop a link in the description below so you can play with it yourself. We're going to start with a $1,000 initial investment and add $1,000 a month each year for 40 years and assume a 7% return rate. We'll use a JP Morgan fund that has an expense ratio of 0.58. And over the lifetime investing, this fund will cost you $333,421.70. And the future value of your total investment will be just over $2 million. Now, let's rerun the simulation again using a Vanguard fund that has an expense ratio of just 0.05. And you can quickly see that you end up with over $300,000 additional in your pocket with a total cost for expense ratios with the Vanguard fund of only $30,000. I wanted to share this article that just came out. Vanguard is announcing the largest fee cut in Vanguard history dated February 3rd, 2025. This is very appropriate for this video. So it just happened by accident that I came across this today, but really excited to share this. Vanguard is lowering the cost of investing effective February 1, 2025 across 168 share classes and 87 funds. The fee reduction are expected to save investors more than $350 million this year alone. And then founder John Bogle, you'll often hear him referred to as Jack Bogle, explains why investment costs matter. So you can read that at your leisure. And I'll drop a link in the description below so that you can review this on your own. This little blurb talks about how lower cost portfolios tend to outperform higher cost ones, and that over the course of 10 years, 84% of their funds have outpaced average results of competing funds. So although Some funds may outperform some of these lower cost funds in the short term. Study after study have proven they do not outpace them. More money in your pocket comes from the reduced expense ratios. And so here's a little video on it. You can again watch at your leisure, just under 2 minutes. And then you can review the different asset classes here, a wide array of asset classes. So please take a look at this, have your investment advisor review them if you're not already in some of these funds, or review it yourself at your leisure. I am not an investment advisor, but again, this was just a happy coincidence that as I was working on this video, I came across this article, and hopefully it will benefit you all. So enjoy that. And now back to our video. So here you can see that Fidelity offers zero cost index funds, and actually they have no minimum investments and again, zero fees. So they're comparing themselves side by side with Vanguard. And here's a list of some of those zero funds. There's a large cap index fund, FNILX. You can look up that ticker symbol. And then the Fidelity Zero Extended Market Index Fund, FZIPX, Fidelity Zero Total Market Fund, FZROX, and Fidelity Zero International Index Fund, FZILX. Now, these indexes are based on Fidelity's proprietary indexes, not the standard indexes. They may or may not outperform the standard indexes, so please do your research on those. But it is interesting that they do have zero cost funds. And then here's a list of low cost funds as well, and they're comparing them side by side with the Vanguard funds. I do want to call out that this was updated as of 12/31/23, and that we just saw that Vanguard has some updated lower fees. So this may not be accurate here, but please go on fidelity.com and compare for yourself, or reach out to your certified financial planner if you have one, or a fee-only advisor. Now let's dig into where these hidden fees might lurk. Expense ratios may go by different names depending on the provider. Keep an eye out for terms like management fees, operating expenses, administrative costs, total annual operating expenses. These might all mean the same thing, and they're often rolled into what's called an expense ratio. Be vigilant about understanding what each term means on your statement. Hidden costs beyond expense ratios. Expense ratios aren't the only fees to watch out for. Here are a few more hidden costs that could surprise you. Load fees. These are sales charges either when you buy the fund, which is a front-end load, or when you sell it back, a back-end load. Number 2, transaction fees. Funds may charge fees for buying or selling shares, especially in actively managed funds. Number 3, 12B1 fees. These are marketing and distribution fees that are often included in the expense ratio, but not always clearly disclosed. Check for this in the fund's prospectus. Number 4, turnover costs. High turnover in a fund's portfolio can lead to additional costs such as trading fees and taxes. Look under the fund's turnover rate as an indicator. So how do you avoid hidden fees? Now that you know where to find these fees, here's how to minimize them. Number 1, look for low-cost funds. Look for index funds or exchange-traded funds or ETFs, which often have much lower fees than actively managed funds. For example, Vanguard and Fidelity have funds with expense ratios as low as 0.03%. Use fee-free platforms. Some platforms like Robinhood or Fidelity don't charge transaction fees for buying certain funds. Take advantage of these options. 3, avoid load funds. Stick with no load funds to save on sales charges. And number 4, ask questions. When in doubt, call your investment advisor or the fund's customer service team and ask directly about fees. So what are the key takeaways? Hidden fees, including expense ratios, might seem small, but they add up quickly and can significantly impact your retirement savings. By knowing where to look and what to ask, you can keep more of your hard-earned money working for you. Thanks for joining me today on Reflections in Real Talk. If you learned something new, give this video a thumbs up and subscribe for more tips on retirement, finance, and living smart. Have a question about fees or investing? Drop it in the comments below and I'll cover it in a future video.